Just now. That's nice. Jesus. That's my stuff up.
Wednesday, I think it is, right? It's hot.
Okay, I was just about to say, mixing up in the morning, right? I'll,
It's a weird year.
What's this?
weird year.
What's this on my calendar?
It's my dad.
It's busy, it's less busy than it was.
We laughed at that. That's what I did.
Thank you very much.
Okay.
I was going to yell at you and remove it the other day, and you were like, no, no, no. I want to know about your mom's pills. It's a family plan.
CPA? Yes, sir. Yes, I'm seeing the same thing too. Some markets are on fire, some markets are.
I've never heard of it.
They're just like cookies.
Oh my gosh, look at back there.
Yeah. Oh my gosh.
Somebody
Slide
Two
this chair back
people
so
have
no one
hit
else
that
does
now.
that.
So it's not just.
Yeah,
me.
yeah, no, slide that back so no one else does that.
Don't walk this way.
Yeah. Hi.
Those. Yes, basically. No, you're fine. Tracy did it right after you.
I don't know.
No, I said Tracy just did it too.
Y'all ready? Good. We're getting there. We're getting there. Go from, we do it like not there. Stop. Okay. Yes. Those have some big slow down. Large house. Yeah. Make sure that there is.
She answered.
Okay, when you try seats, you can. What? Please. Because I want to sit with me.
Yes. If I had.
I don't need that. No, I don't need that. It's not even orange. I like your shirt. I almost wore mine today.
Good thing you did.
I didn't, I just, you know what, I am such a dress wearer always, and I have hardly worn dresses this year because I always wanna have something loaded on it. And so finally today I was like, I'm over it, I'm gonna wear a dress.
I had such a bad morning.
Well, I did buy an EXP hat and a visor at Summit, and I love them, because when you're having that down hair day, all of a sudden you're in uniform. Yeah.
Have you gotten any?
Yes. I
Good morning,
have.
Timothy.
Good morning.
Who do we have on Zoom? Cindy or Kathy?
Kathy.
Looks like Cindy. The picture does.
So
I
Maria is
did
not
text
in the
Cindy. She said
process.
she is coming in.
I didn't even ask you.
They usually all start funneling in like 5 minutes after.
I know,
The life of being a real estate agent. Kathy wins a gold star for,
being first.
yes, being first.
Yeah, it's Bill.
I like the one. Mike doesn't like.
I would like a Velveeta snack bar.
You would like a Velveeta snack bar. Cheese.
Felony and lots of cheese. All right, we got a couple people coming on. I'm gonna go ahead and get started because I do feel like this is probably gonna be a very good collaborative meeting. So I'll get us kicked off. First, we have breakfast and some good information from Eric. If y'all don't know Eric, he has been around forever. He knows all things home inspections, does a very, very thorough, fantastic job. He actually teaches other home inspectors. He's that good. So wanted to give him a couple minutes to just introduce himself, tell you a little bit about him and his business, and then we'll introduce Matt. So take it away, Eric.
Thank
If
you.
you want to be on camera, you come over here.
Good morning.
Good morning.
I gave,
Hot seat.
huh?
That's the hot seat.
Okay, I need to be on the hot seat. I gave you all this sheet. We don't need to read it, but the front of it says avoiding the aggravations of home inspections, and it's places I need to get when I'm there and common problems. Like when I say places I need to get, we're required to take the cover off the electrical panel. If it's in the garage behind the freezer, I'm not moving the freezer, because if I break it, and I have had to pay for the contents of a freezer before, I'm not going to do that again. So just if there's a couch in front of an access to get into an attic, we're not going to move anything. So that it talks about places that we need to get, and it talks about problems that we see every single day. For instance, a light not working, which is more than likely a light bulb problem, but I don't know that. So I'm going to put a defect in the report. You all know, dealing with buyers, the more the defects, the more nervous they get. So the longer the report, these are simple things that the seller could fix. Fixing lights, is there a simple leak under a sink? Just things like that. And the seller could notify us. If they know there's a leak under a sink, they could tell me before I spill water all under the sink. But just simple things. It's a great tool. It's a great sheet to give to your listings to say, this is what the home inspector, these are the simple things the home inspector's going to find. Because in my experience, everybody says, there's nothing wrong at my house. So, the back is about us. You can read that. I don't need to read it for you. What do we do that you don't like? Oh, and I can try to explain maybe why home inspectors do it, but what do we do that drives you crazy or you don't like or bothers you?
Well, it doesn't bother me because I've been in this a long time. I know it's happening, but I'm gonna answer the question because I think there are a lot of people who follow me here. alarm a client into thinking that a small fix is a major issue, and now they're terrified to buy this house because it's gonna fall down over a $13 GFI outlet.
And I can't speak for all home inspectors. It is my job. And I do teach other home inspectors, and I teach pre-licensing education to the people coming into business. It is our job to educate, but there was a long time ago that our board tried to come up with a standard format. Here is the report you have to deliver. We fought it because that happened in Texas, and home inspectors got $100 and it took them 30 minutes to do a home inspection. So we fought that. Different people are going to pick up on different things. And it's amazing to me, the buyer's experience is what tees them up. Because I can tell you there's polybutylene in this house, and a lot of people don't care. But if anybody's had polybutylene and it's leaked, they're out. And I've had realtors call and say, will you go look at this house and tell me if it's polybutylene before they even make an offer? Because they, so everybody has their points that I'm not going to buy it. I had a gentleman that when I explained decayed siding and he got confused, he said it's fiber cement or hardy plank siding. I said, no, it's not. It's masonite siding. He didn't buy the house. The seller agreed. And he said, this listing says it's fiber cement siding. I said, I'm sorry, the listing's wrong. It's masonite siding. The seller agreed to replace the siding, but he was not buying the house because he had difficulty.
I would have taken that break and rolled on.
But what decay is under the siding is the question. He had a house with masonite in the past that had all kinds of problems. So, right, that's his point. So we try not to scare, or it's our job to educate. And I was teaching a class this weekend and asked, have you ever told anybody to not buy, right? Because by our standards, we're not supposed to answer that question. And we get asked every day, would you buy this house? Or I had one young lady say, I heard you talking to the realtor about your daughter. Would you let your daughter buy this house? And I thought, no, but that's not my job. My job here is to help you understand these facts and you make your decision. Any other questions I can answer about home inspection?
Besides this, what do we do that drives you crazy?
You don't, not at all.
Yeah.
Not at all. But we did get, let's see, Friday, an inspection popped onto the calendar. Somebody went online and scheduled it and said, we're not under contract yet. And it was for Monday afternoon. We had an opening Monday afternoon. It was, and Saturday they sent an email, all right, cancel that inspection. So I understand it's a weird year. April asked me how we're doing. It's a weird year. So
Yeah, I agree.
Same.
I left these little blue things out there with the biscuits. They are COVID vaccine card holders. So you're welcome to have them. And if y'all need more, let me know.
Quick question, do you do all your scheduling online, or can people call you to schedule?
I have an office lady, so someone is always answering the phone, because if I'm in a crawl space, I don't answer the phone. So there's somebody, you can do it by phone call, you can do it online, you can text her, whatever.
Okay.
We can get it scheduled.
I love that you have the online scheduling, so you just sit there with your client, and sometimes, so many times we call and text back and forth with our inspectors, like, I can't do 9, but I can do 11, or I can't do this. I'm like,
Yeah.
let me just go
Yeah.
and see what you got. Y'all good? Okay,
Yeah.
we're done.
And I have another inspector, so we can have some quick turnaround if you need it. We can work it out.
And is your pricing on your website?
No. If you do Google statistics on any website, but on a home inspector's website, and you watch where the people go, they leave your website from the price page. So it says, we start at this, and I want you to call the office, because now my office manager can sell it, where we can't sell it if you're just looking at the website. We are not the cheapest, but I've been doing it 25 years. So I've seen a lot that a lot of these people have.
Thank you again for breakfast.
You're welcome. Thank you.
Thank you.
Thank you.
Okay, so now I'm excited to introduce Matt Bustamante. He is a local accountant, CPA, all the things. He works with a lot of small businesses. His wife owns one of my favorite small businesses, 104 Boutique. So anyway, he's here to answer all your questions. We were hoping this to be like a, he can give you a spiel about him, but then a very honest, like I said, a question and answer session. We've got some really experienced realtors in the room. We've got some that are brand new. So I think it's good to hear all the things nobody told me for the first 8 years I was in the business that I should have been doing to save money on taxes. So anyway, I'm gonna turn it over to Matt.
Awesome. Thank you. Yeah, as April mentioned, I would like this to be a Q&A thing, so I hope y'all can kind of drive the conversation here. There's a few points that I'd like to discuss, but number one is entity selection. So when we talk about LLCs and corporations and sole proprietors, I would assume probably most of y'all are sole proprietors. Is that right?
No.
No.
Yeah.
S corp?
There's a few LLCs in the room.
Okay. All right.
Ask me what that means.
Don't ask me what it means. All right, hey, look, we're about to lay it on you right here. All right, so an LLC is just it's a legal entity that's created. It's a state-to-state thing, so not an IRS thing. So an LLC is what they call a disregarded entity according to the IRS. So it's not a taxable entity. So what that means is you can be a sole proprietor as an LLC, you can be a partnership as an LLC, or you can be a corporation as an LLC. So, and each of those are taxed differently. So a sole proprietor, a single member LLC, okay, you're going to put all your business activity on your individual return on a Schedule C, and it's going to be taxed very, very differently than like an S corp or a partnership. And when we talk about when should I transition to an S corp, it's really going to be dependent on profitability. And the big difference is, I wish we had a whiteboard here, so that I could actually show you the difference, but we don't. That's okay. So a single member LLC, you're going to be taxed on Social Security tax, and Social Security tax is 15.3% immediately. You are not getting away from that. Okay, so the Social Security limit is 147,000 for 2022. So let's just take an easy example here. Okay, so if we put on the tax return that we made 147,000 as a single member LLC, okay, so non-corporation, non-partnership, we're going to be taxed on 15.3% Social Security tax immediately. That's not federal tax. That's not state tax. That's just Social Security tax. Okay, so whatever that comes out to be. Okay, as an S corporation, okay, we're talking about the difference here. As an S corporation, there is no Social Security tax. Okay, only on the salary that the IRS says that you have to give yourself as a shareholder. Okay, so and that is a reasonable salary. So it's very great. There's no salary that you've got to have as a real estate agent. That's up to you to determine what a reasonable salary is. So let's just say your salary was $47,000. Okay, so we're going to put on our tax return $47,000 on the S corp. So that $100,000 difference there, we are about to save $15,300 in Social Security tax right off the bat, just because we're an S corporation, because we don't have that Social Security tax, only on that salary. Okay, so why isn't everybody an S corporation? Again, it just depends on profitability, and there's going to be a lot more administrative costs too with it. So with an S corporation, you have a separate tax return. As I mentioned earlier, the single member LLC goes on your individual return. So the return and all the business stuff is kind of lumped together. With an S corp, you've got a corporate tax return. You've got quarterly payroll tax returns as well. And the bookkeeping is a little bit more extensive on that, because you've got what they call a balance sheet on the tax return, on a corporate tax return. Whereas a sole proprietor single member LLC, you do not have that. So there's just a few things to keep in mind. Hey, she got it. She got it. That is awesome. That is
You just want to
fantastic.
get the TV if that works.
Awesome.
Okay.
And the beautiful thing about an S corporation too is this, and I'm gonna try to write really big here, but is, as an S corporation or any business, you should really have financials. Financials, are the lifeblood of what we do, and it kind of gives you direction of where you're going. So you've got y'all can't see this over there, can you? Yeah.
Push that one.
Okay. You've got a profit and loss. And that does stand for balance sheet. All right, so the profit and loss, everybody understands this is very, very simple to understand. You got your deposits, which is your income minus your expenses, and then you got your net income. And that's ultimately what you're taxed on. So that is a very, super important document. The most important document though, especially if you go to S corporation or partnership where it's a little bit more extensive on the bookkeeping, is the balance sheet. And the reason being is because if you tell someone that they made $200,000 at the end of the year, and here comes this big old tax bill, right? And they say, hey, no way I made $200,000, and because of the tax bill. Here's how you tell them. So when you look at the year-to-year comparison, say we're comparing 21 to 22, right? And then you got these balances that you're comparing. So when you tell them you made $200,000, the money's either in four places. It's either in your bank account. So this increase from 21 to 22, that takes profit to get there. Okay, it's either in assets. You purchase assets. That takes profit to do that. You pay down liabilities or debt. That takes profit to do that. Or you take them through equity. And that's how you prove that someone has made $200,000. This is kind of advanced here. Probably not a lot of CPAs probably go through it that in depth, I wouldn't say. You look like you have a question.
No, I didn't want to squirrel us, but I do want you to circle back at some point to the assets. What are assets that we can purchase that are tax write-offs? I know for years it was like, oh, buy a new car every 2 years so you could write it off. So things like that, I just want to make sure we circle back to are things that we can and can't consider assets that we can write off our business.
Yeah. So that's actually a good conversation piece there. So regarding the vehicles, that is something good. Okay, so you've got two different ways to write off vehicles and just auto expense. You've got actual expenses and then the mileage rate. So typically when you see someone as a single member LLC, a non-corporation or partnership, then you see them a lot of times take the standard mileage rate. And it really just depends. I mean, there's no one size fits all. A lot of times when you see somebody that has a corporation or a partnership, then you're going to see them take actual expenses. So every time you go to the gas pump, every time you do oil change, every time you buy tires, every time anything with that vehicle, because we have wrote off that vehicle, is going to be deductible for that. Okay, so the one thing, if we do that way, okay, take depreciation on the vehicle. And by the way, depreciation on the vehicle just means that it don't have to be a new vehicle. It could be your own vehicle that you have personally, that now you've started this business, it could be paid off. Depreciation is going to be the fair market value of the vehicle. Okay, even if it's paid off, it don't have to have a loan on it. But if it's over 6,000 pounds, and we've got an option to take 179 expense deduction, and basically that means we're going to take the full value of the vehicle and appreciate it in year one. The thing we've got to be careful with that is, let's say we buy a vehicle for $90,000. I feel like everything's $90,000 right now. But
Except for houses.
except for houses. That's right.
Keep on that.
That's right. Say we buy a vehicle in year one for $90,000, and our profit was $90,000. So that takes our net income down to zero. Beautiful thing, because we could finance the whole thing. We don't have to put 1 cent down, and we can still take that deduction of $90,000. So that's great for this year. We'll say what that's right. So and that's called 179 deduction. That allows you to do that if it's over 6,000 pounds, and not a luxury vehicle. But
What's defined as a luxury vehicle?
Did you say luxury?
luxury.
I
Yeah.
thought you said electric. I was like, hold up, back up.
No.
Actually,
And-
the X is over 6,000 pounds, so you can't write the whole thing
Yeah.
off. Is that what
Yep.
you have? No.
No.
Yep, and as far as electric goes, that's very manufacturer specific and model specific, so you'd have to go through that. But yeah, there's a lot of good stuff out there for that too. But the thing that we've got to be mindful of on the vehicles is like, say 2 years down the road, so you get tired of that vehicle, and I'm gonna get rid of it. I'm gonna trade it in. So you got a $90,000 vehicle here, and we just took $90,000 depreciation. Okay, your tax basis or book basis is zero. Okay, so if you go to the dealership and trade that thing in, and say the dealership gives you $60,000 for that, well, that $60,000, we have got to recognize as income. Because we've taken advantage of the depreciation, but we've got to recapture that depreciation again whenever I trade it in, okay? But we can fully depreciate the new thing that you're getting. So as long as it's above this,
So don't buy cheap.
then you're in the green. You're in the green, you know, so to speak. But that's something that surprises a lot of people though, because they don't.
I've been trying to get my husband to agree, let me get a new car for a long time, and it's done now. It's done.
It's done.
It's done. I'm doing it.
Well, so here's the thing too, is like, everybody here is self-employed,
Yes.
100%, because you get a 1099, okay? There is a major difference between a W-2 employee and a contractor, which is like what y'all are, 1099. Okay, and the difference is this, is as a W-2, I go to work, I'm taxed, and then I get my paycheck, and then I can spend it. Okay, as a 1099 self-employed person like y'all, okay, you make your money, you spend your money, and then you're taxed. Yeah. And then you're taxed. So if we're doing the right things, that's a big difference, because a W-2 employee don't have that latitude. I mean, there's not a whole lot of W-2 employee can do on the tax return, just because the government's taxing it, you know, right away. You know, y'all are making it, you're spending it, and then you're taxed. So that goes a long way. That goes a long way, especially talking about assets, vehicle specific. I mean, because depending on your tax bracket, I mean, that $90,000 vehicle, you're really buying at a 25% discount, because we're taking depreciation on it. Does that make sense? Yeah. But and then as far as other assets goes, anything less than $2,500, the IRS says that we can expense that, no problem. So anything above $2,500, they want us to capitalize it. And then that's something good to know. And just to note too, when you go to the bank, a lot of times they add back depreciation. So like in this example here, if you made $90,000 and then you just took $90,000 depreciation on the tax return, so it'll look like your income is zero, but they're going to add back that $90,000 for depreciation. Okay, so and then that goes for anything that we capitalize. So even on something that's say $2,500, if we're expensing it, then the bank just thinks that's an ongoing expense. But if we capitalize it, then they always add those things back. So that's something good for buying power to think about.
Would you say it's a fair point or assumption, A, if you're sole-proprietor and you're not a corporation, B, you're driving a vehicle you plan to drive until the wheels fall off, that you're better to write off mileage than you are to depreciate it, per se?
If you're going to have that vehicle for a long time, depending on how much you drive, I mean,
A realtor, so a lot.
as far as mileage, like 30,000 miles, 20,000 miles, what do y'all
I'm
driving?
averaging about 35.
I want to say I'm closer to 50 or 60.
Yeah.
50 or 60. Yeah, that's a big write-off, friend. I would probably do the mileage.
Yeah.
I really would.
Especially if you have an electric car, then it's definitely better to do mileage.
Yeah.
I mean, I figured it out now.
Yeah, that's right. No, mileage is a ticket on that then, I think, because then you don't have to worry about this. You know, you just can't take the auto expense and, you know, all that stuff.
Say that you do take the auto expense. Do you have to take it all at once, or you can divide it over multiple years?
Say that again now.
If you take the expense for the purchase,
Mhm.
can you take
Oh.
that in 1 year? Like say that you want, it's $90,000, but you don't want to make zero because you want to have some purchasing power.
Yeah,
Can you divide that over multiple years?
absolutely. So each asset, depending on the asset's got a tax life, and the tax life of a vehicle is 5 years. So we have the option to take that 179 either all in full. We can take 179 on a portion of it, or we can just say, hey, look, I want that over 5 years. And depending on when you bought it in the year, will determine, you know, how much depreciation you have for that particular year. And then it kind of evens out over the remaining 5 years there.
Ask me why I keep getting new cars.
Just as an example, when I finally went to an S corp, our tax liability changed, and so that was the year we were like, okay, we need some more write-offs. So we're gonna just go ahead and depreciate my car completely, because we felt like in the next 2 years I would get a new vehicle anyway. And so it made sense to just take it in one chunk at that time to reduce our tax liability for that particular year when we made the switch, and then, you know, just look forward and that's to what made the most sense.
Absolutely. Here's the name of the game with taxes. I mean, we're worried about this year. We are worried about this year. So I would be as aggressive as we can for this year, because who knows what next year's gonna be like? Who knows what in any industry, I mean, anything. So, it's all about deferring revenue, accelerating expenses. That's the name of the game there. So, and I would assume, so when y'all make a sale, you're gonna get a 1099 based on when that sale occurs.
We get 1 1099 end of the year.
Right. So, but that sale is gonna be captured within that year, right? So if you make a sale, like if you have it closing on December 30th, but you don't get your money till January 4th, whatever,
December 30th.
December 30th. Gotcha. Okay.
Right?
We don't get paid on the year.
Yeah.
We paid the following year. It doesn't record until the following year.
Yeah.
So it'd be on the
When
4th.
it records.
Yeah.
Be on the
So-
4th.
So if we get paid,
Yeah, we get paid
yeah, it's when we get paid.
Yeah, but we sometimes get paid
Okay. Got it.
the same day that it closes. I mean, even if the year changes, then if the tax code changes for that year, which one is that particular check fall under, or that liability, or yeah.
It would depend on when he writes the check.
It won't.
No.
Okay. Got it.
No.
Yeah, no, and I was just wondering, because like I know for a lot of businesses that have a latitude of holding checks and that's a big strategy you see for just people in construction, developers, anybody that are getting checks. They're gonna hold deposits in December, and then prepay expenses again, because we're worried about this year, not next year. So
I have a question. So
Uh-huh.
if your car, does it matter whose name is the car is under? For example, my car, the car that I drive
Mhm.
is under my husband's name only. I mean, I can still write it off because I'm the only one that uses it.
what? Yeah, that there's not a problem. What kind of entity are you? Are you a single member LLC?
I'm not,
Just a-
I'm
no,
just 1099 right now, yeah.
Okay. Yep.
Yeah.
That's not an issue, even if you're an S corp, right? Even if you're S corp, if it's in your individual name, that's no problem, because you're a shareholder of the entity. That's not a problem at all. A lot of times you've got the tax dilemma, the legal dilemma, and the insurance dilemma. There will be no dilemma for tax. Now, if you were driving that vehicle and you wrecked it or something, and it was in somebody else's name and y'all weren't married, then I can see that being an issue. But
You talked about already when it makes sense to go from sole proprietor. I know you were talking about the differences of what an LLC is and an S corp, but when it makes sense to go from sole proprietor to an S corp.
Yes, yep, we did.
Okay.
We touched on that, and it's just gonna be profitability. And then, does the social security tax savings, does it outweigh the administrative expenses you're gonna have? Because there is gonna be more administrative costs with it. So, and the cool thing with an S corporation too, is there's something called the Augusta rule. Have y'all heard of this?
Mm-mm.
It's, so basically what it allows you to do is it allows you to rent your house up to 14 days. And you don't gotta pick it up as income. It's called the Augusta rule. It is a little tax loophole, and that's for shareholders of a corporation. So you can rent your house for business up to 14 days. The S corporation can take as a deduction, and you pick it up as income, or you do not pick it up as income. I'm sorry. So that money's coming to you tax free, and you're creating a deduction for the S corporation. So it's like a double whammy, which is a good thing.
I have a question. Is there like an amount that you say, okay, you make this much, let's go ahead and become an S corp, or?
I would say probably around $65,000 to $80,000. Yep, I would say in that range. Yep, because again, the reasonable compensation is going to be up to you. There is no guideline, like real estate agents have to have a $50,000 salary or whatever. I would try to make the salary as reasonably low as possible. Yeah, that would be, again, because the salary is subject to social security tax. The flow through, it's not. So on that example that we said earlier, that was a $15,000 savings right off the bat. So, and not for doing nothing.
I don't think I write off enough expenses, and I hold on to everything.
You hold on to everything.
I really do. She does. But I have an LLC and an S corp, and I have the lowest amount you can for LLC on that one. So when we get taxed, it's more, I don't get taxed business sign, personal,
Right.
new tax bracket.
There's a lot of expenses that she does not write off, that she should.
Okay. Well,
I don't know if I should or not.
All right.
I do
Everything
my,
we
I do mileage, I don't do gas.
Okay,
My car, I pay off out of our personal, I don't pay it out of my business.
okay.
When I go and get gas, I don't pay it out of my business. But like paperwork or computers, things like that.
Well, I know y'all spend a lot on advertising that, right?
That comes out of not really.
Not really?
Sorry, we're small.
Okay.
That comes out of some of those expenses too, but I guess I don't feel like I spend a lot.
can't do both, though. You can't.
Cannot do both on that
mileage
particular vehicle.
and- Yeah.
It's gonna be vehicle specific.
Okay.
Yeah.
Yeah.
And that's again, something to take note depending on your vehicle. For me, I don't want to keep up with it. And so I would just soon take the mileage, even though some years I lost and I did have a gas vehicle. Now, obviously, having an electric vehicle makes so much more sense just to do mileage because I'm not spending money on gas.
Yeah.
Circling back just real fast, since we do have some brand new agents in the room, if you don't have a completely separate credit card and checking account for your business expenses, that needs to be the first thing you do. That's the easiest way to keep up with all this, and you're not having to keep receipts and pay yourself back and come to Matt at the end of the year with a shoebox of receipts. It's just kind of like, here's my credit card statement.
Oh, yeah. Well,
That's why we're here today. We really want to know.
That's why we're here. That's why we're here.
I didn't think I was gonna make it.
I
I gotta go to this.
easiest way, and I'm, for the record, again, I did it. I actually keep mine in 3-ring binders with a month with 12 sheet protectors, and you just stick the receipts and all of those. But I did that for years, and I was like, there's gotta be a better way, and the easiest way is just to create a whole separate business checking account and a credit card, and so every time I pull that card out, it is for business only.
Absolutely. Very, very good point there. And just, yeah, taking it back to basics. I mean, so you go to the Secretary of State, you get that LLC created, got that. Okay. All right. You can get an EIN if you want to. Okay. If you want to, but an EIN, if you're a single member LLC and you don't plan on ever having payroll, you really don't need an EIN.
I
You
get
can just,
payroll, but it's for myself.
okay. So in the S corp,
I think so, yeah.
And
I pay my quarterly taxes, so then they do it all.
Yep.
They send my payroll, like, here's your monthly,
Yep. So
here's your taxes.
if you are going to have payroll, then 100% need an EIN, because, a lot of times employers don't like, their social security on W-2, like their social security number on W-2. So you get that, and then you get your bank account set up. And then like April mentioned there, I mean, game changer, especially for, at the end of the year when it's coming to me, is because, it saves time. So usually when you save time, it's a little bit cheaper for you.
So do you need all the receipts if you have a business credit card? Because I have both.
I personally do not. I personally don't.
I don't have to turn them in, but she wants me to do a profit loss, but I keep the receipts in case there's any questions.
And I always said for us, I didn't necessarily for my real estate business, but when we owned the brokerage, I kept every receipt just for that reason. If we ever got audited, because it needed to be separated, I made sure I kept at least one because it was easier to keep up with it that way. But no, most accountants don't care about your receipts. The only reason we keep receipts is for us in case we get audited and we can prove it. But I feel like if you're looking at a credit card statement and I can reference back to the calendar on my phone that said, this is what I was doing this day, this is why I spent this.
Right.
Then you're pretty clean.
And I know for my particular firm here, and I feel like I can talk a little junk because I was at other firm for 10 years, but there is a very lacking area in the CPA world, and it's called advisory. Very lacking, 100% lacking. And so my firm, just like y'all's name, has advisory. That is where the value's at. A lot of CPAs can put numbers in the right form at the right time in the right place and file it on time for you and all that stuff, and life's good. But the advisory portion is going to be huge, because nobody wants to get to the end of the year in January or February just to learn that they've got a $60,000 tax bill. Because at that point, we're talking about historical information, and now there's not a lot we can do about it. That's, we're sort of done. So the advisory portion is where the value is. And to have advisory, we've got to have a set of books or something that we can kind of gauge ourselves on to understand where we're at. So that way we can tax plan and give, advice.
So we do have a question from Megan. She wants to know what's the best way to go about getting a business card. It doesn't have to be a business card, though. It can be like your personal card that you only use for business, right?
As long as it's a separate account. The only dilemma with that is a lot of times personal cards, they'll run from like the 15th of the month to the 15th of the month. So the the dates are kind of weird.
Mhm.
Whereas a business card is going to run from the 1st to the 31st or 30th. So like when you get a statement, you're gonna be able to capture that, easily within that month, especially when you're running financials, because most of the time people don't look at financials, from the 15th to the 15th of the following month. It's, hard dates. So,
And don't get too hung up in the fact, like, you don't think business account has to be with some major entity, like,
yeah,
credit
that's
union
right.
doesn't do business accounts, but every other local bank does, and all you do is just label it something different, like, with ours is it's still at First Bank where our personal stuff is, it's just a separate account that we call business account. I have a regular credit card and debit card, just like I do for my personal, so it's literally the same, just labeled different, so we know to pull our statements from that side versus this side.
Yep.
So, and I think most of the time, if you do call it a business account, there is like a $25 charge for the year or something like that, just
Right.
because, but it's not some massive undertaking.
Right, that's right.
So you don't need, to what I understand, an EIN number, isn't that needed in order for you to open up a business account at a bank?
It is.
So regardless of
from-
whether we go sole or
Yeah.
or not, we still need to request that.
Yeah, so from the bank standpoint, they are gonna want that for sure. From a tax standpoint, it don't really matter unless you have payroll. But yes, to start a business account, you're exactly right.
So if I open this business and I deposit my commission check in there, and I wanna transfer money for myself to use for expenses.
So, good point, very good question there. So, as a single member LLC, a sole proprietor, that is called a draw. That is called a draw, so it is not payroll. So, and really, it's just gonna be a play on words kind of, but payroll is meaning that federal taxes are withheld, social security, FICA, that type of thing, that's payroll. But if you're a single member LLC, as the owner, there is no W-2 for you. It is just a draw. It's a untaxed distribution. So what I mean by that is, let's just say you deposited $10,000 and then you drew out that $10,000. So now your account's back to zero. Well, on your profit and loss statement, your income is still $10,000. So we can't take an expense on our draw. That's you taking equity out of the company. That's all that is.
How do we, so if we deposit our commission check and we need to use it for something, how do we use it? Like, what will be the best way to pay ourselves with a check by our company or?
Yeah, so that's a twofold thing there. So if you are using it for your personal expenses, that's what I would use a draw for. Okay, I put in 10,000, say I need 5,000 to live on for the month or whatever. I would take 5,000 out to pay your mortgage, all your personal items, any business items, use that card. So that way we can capture it within that statement. So that way it's easily identifiable.
I have a question about that. So the way that we're structured is EXP will send us the check, and then like Lana and I are a incorporation, which probably is completely wrong. And what we do is, since we're paid EXP, then we deposit into our business account what we need to function for the business account, and then everything business wise comes out of that account.
Okay, so you
Is
make a
that right?
sale, check goes to y'all's business account.
No, it goes to our personal accounts.
Okay.
And then we take what we need to survive for the business and we send that.
Did y'all recently make this change?
No, this has been how we've been operating for 5 years.
Okay, all right. What?
You do your own tax returns.
That's why. How much do you charge for a consultation?
What I would, yeah, hey, look, what I would do in that situation is I would just have them change to an EIN number and then deposit it to the company name.
And so,
That way-
so we should be depositing into the company name and then just distributing.
Oh, no,
Yes.
we got a big,
I would.
we got big issues.
So let me simplify if I can, and you tell me if I'm
Yeah.
wrong, but again, so you gotta look at it as, take the S corp part out of it, but you're putting all your money in one pot, and then you're going, you know what, I need to set aside 35%, y'all write these numbers down if you're new, you need to just think in your brain, 35% for taxes. Leave that in this account, and then let it build up. I know, like you said, I need $10,000 a month to live on, there's 20 in there, so I'm gonna give myself a draw, just like with regular business, it's a dividend for lack of a better word, it's not
Yeah.
right. So you're taking money out to live off of, but it's still better to keep a lot of that in there throughout the year and let it kind of build up and just. And this kind of sets you up for, this is what I need to live off of when you do go to an S corp and you are truly paying yourself a salary and the taxes are being taken out ahead of time.
Yeah, 35% would be a very aggressive but good number to just keep in your head, because again, if you're not a corporation, you've got 15% social security tax, 15.3. And then let's just say you're in the minimum, say 15% tax bracket. Okay, so that's 30%. And then your state's 5% there, so that's 35%. That's sort of how you get that.
And if
So,
you use the same mentality as what you just said, pretend we're a W-2 employee, so it's going in, being taken out, and then we get what's left.
We're
Yep.
very kind of similar to them, but not. So we have Southern Key, which is a DBA, doing business as. Each of us are paid into our LLC. At that point in time, we take a certain percentage and put it into another business account to pay expenses. That's why my expenses are low, because we really have.
We share marketing expenses
okay,
only.
okay.
We don't share income.
You do not share income.
It's separate commission for me is paid into my
And that's
LLC
for
from
income.
EXP.
Okay.
And then I transfer a certain portion for expenses.
Okay,
And that's it.
That's basically, we do
So
the
I
same
still
thing.
get it on my
Yeah.
1099.
so perfect. Okay, so that 1099.
My CPA said we need to form a partnership or another LLC. And I don't feel that we need to.
Okay, a partnership is,
Like,
it's probably the most difficult accounting.
Okay.
Because you've got what's called inside and outside basis on the balance sheet, which that's another conversation there. But is a lot more difficult actually than a corporation, really, in my opinion.
So we do
The
it.
the bookkeeping. So let me ask you this, so your 1099, whose social security or EIN number does that go to? Is it like,
Well,
for-
my sales go to my number and her sales go to hers.
okay, is it your social or EIN?
Social. I can go to my social.
Okay,
Well, so I have a sole partnership with
Okay.
EIN.
okay, so your EIN is a sole proprietor and your EIN is sole proprietor. All right, you're, okay,
LLC,
Yes,
S corp.
sorry.
S corp, okay.
We're both S corp.
Okay, both S corp, okay, got it, all right.
Completely separate on commission.
Yeah, got it, okay, so 1099, so
So
now-
all we do is take a portion and put into that. Say, let's just say our bills were 5,000 per month. I take 2,500, she takes 2,500 and dump into that account. That's what we do.
For expenses.
For
on this.
expenses.
And then we keep that expenses for write-offs. But I don't understand why we would need another, because we're paid separately. It's not being written to the business. 'Cause it's
Okay.
Not
Yeah.
a true LLC. It is a doing business as.
I got you. Yeah, I'd say let's talk on that and let's see what we can do on that. Yes, ma'am, absolutely. I think there's a better way,
Okay.
for sure.
Because I just didn't want to mix it in my personal, so everything is separate.
Yeah, that just would
That's why I
be
have 5
another
checkbooks.
checkbook.
Just another checkbook.
So
Yeah.
I am really expensive for
I have
this
my-
year. And then figure out your accounting for next year.
Yeah, that's right. That's part of it.
I can tell you, I know that I'm not doing my stuff right, and that my goal for this year was to try and figure that out. And my first thing was to separate out as much as I could, and that's why I really started using our business account more than what we were. And like, I got QuickBooks and everything, although I haven't really been in it. It's all linked and doing its thing, but
Right.
hopefully that'll at least make my life a little bit easier when I call you.
Yeah, absolutely. Absolutely, friend. Absolutely. No, and those books are so important, especially as you grow and become bigger and bigger. I cannot stress how important those books are, especially for the advisory portion. I mean, they're without any kind of gauge, you cannot advise. You cannot. So,
I'm gonna throw this out there too now. Say that we have this business, and then both of our spouses are self-employed and have their own businesses
Mhm.
too, and we're filing jointly. How does that play into this picture?
I actually don't want
I mean, like, because I feel like that's a bulk of this room.
yeah, absolutely, friend. So the cool thing about a K1 is, depending on the percentage of ownership that you have there, or a corporation, you get a K1. So from that corporation, you're going to get a K1, and that's really how. So corporations and partnerships do not have a tax liability. There is no tax liability at the corporate level or the partner level.
Maybe that's why we did that.
The catalyst is the K-1 that goes to you individually. So if you file married, file
No
and
idea
jointly
what that
return,
is.
it's just a form that gives you your proration of income and losses based on percentage of ownership.
And what did you say your fee was for consultation?
It depends. It depends. There is no, I really, truly, friend, I mean, I really don't have a standard fee.
Can you talk back about other expenses and write-offs that we can do? I know some things have changed recently. We used to be able to write off all of our meals and entertainment, and now we can only write off per portion, correct? And how
Yeah.
is that justified? Can you talk a little bit about what other write-offs we have?
Yeah, so in 2018, the world kind of changed as far as meals and entertainment goes. Entertainment is no longer deductible since 2018. And we'll sort of expound on that a little bit. But last year, the IRS said that, so typically meals are 50% deductible. Last year, they allowed 100% deductibility on meals because of COVID, and, you know, the restaurant industry sort of took a pretty big hit. So they're trying to, you know, tell people to go to restaurants. So that did help. But as far as entertainment goes, and then isn't there like a $25 limit for client gifts, things like that y'all have? It is ridiculous. It really is. So the way
But
to
if you brand it, it's considered marketing.
This is why we brand everything.
100%, and even entertainment, you know, the kind of workaround on that, we're on a camera, are we? We are.
We
Okay.
All brands do.
But is client relations and employee relations. That's something that a lot of some CPAs will use to kind of categorize entertainment to make it deductible, because now it's fully deductible.
So if we go to a restaurant for our team meeting,
That's 100% deductible. Yeah, that is 100% deductible. And meals are still 50% deductible depending on, you know, what you're doing. But if you're taking a client out, that's where they say 50%. If it's for your team, that's what they say is 100%.
It's really great if you put all these things in your calendar, so if you ever do get audited, you can show the IRS, well, this is why I wrote off this to the clubhouse on this day, it's because we went for.
Every Wednesday.
Every Friday.
Yeah.
Team lunch.
Oh yeah, absolutely. And you know, the IRS code is kind of weird, because then they say like, okay, well, if it's a lavish meal, then all right, well, what's a lavish meal? You know what I mean? So, because lavish meal to me might be different to you or you,
Yeah.
you know, so it's kind of
That goes back to the thing you said, it wasn't a luxury vehicle, was it?
So what does that mean?
Yeah,
What is
what's considered luxury? Like, if I go buy a Mercedes, is
Like
that
if I
luxury?
afford that?
That's luxury to me. A Land
Yeah.
Rover, that's
Yeah,
luxury.
absolutely. And that probably would be categorized luxury. Like, let's say, for instance, they've got certain rules, like on a Jeep, you know, like on a Jeep. And I just know this because we have a Jeep and ours was stolen. Yeah. But you can only depreciate up to a certain amount per year, and it's $18,000. It was last year. This year, I'm not sure what it is this year, but and so you're going to take it over 5 years, is what I'm saying.
Yeah. Okay.
So, but the meal thing there, that it's at least 50%. It could be 100%, depending on the nature of it. And then the entertainment, I would use the heck out of client relations and employee relations.
so I have a question. One of my friends told me that while we were traveling on a conference, that if you bill your meal to your room, that you can get, that will be deductible. Is that true?
Well, so it's like this. So well, hey, no, that's actually,
I'm just saying a friend.
well, so that that example would be no different than like going to CVS and saying this is, you know, buying a candy bar or whatever, and saying this is for janitorial expenses and then drawing out $100. You know, there's no detail on that when on the bank statement, you know what I mean? So
as long as it's not an itemized receipt, they can't prove one way or another.
well, that's right.
That's
Yeah,
on my statement.
that's right. That's right. So yes, I have seen that.
Okay.
Yeah.
Yes. What was your question?
My question is, so there is
there's nothing, no improvement you could possibly do to your house, even if you work out of your house, that can be written off.
So, all right, so when we talk about a primary residence, that is correct. Yes, ma'am. So the IRS does give us a little home office deduction that we can take. And, and there's two different methods on that. So what you can do on that is take actual expenses where you say this percentage I use in utilities. Most
I'm
people don't
talking
use
about
it.
a big improvement, like you had to reside your house, like none of that is.
Oh, not for primary residence.
What
Not
about
for-
secondary residence?
Well, no, not for a secondary either. Now for a rental though, a rental you could, one
So
that
you
you're
could
renting
reside
out.
the beach house if you say that you rented it out.
Yeah, so the cool thing about a rental is anything you can deduct, even mileage going down there, so.
And then for a home office, it has to be a dedicated home office, no couch, no TV, or something.
Yeah, so the IRS says it can't be like a kitchen because you
Because most of us.
cook
are
if, yeah, you cook in there, not in our house, we don't cook, we just got to eat, but.
Same.
So- But yeah, you cook in there and you do other things, so it's gotta be dedicated, that's what they mean when they say dedicated.
But could it have like a guest bed, like this can be a guest room when people come, but it still has a desk and a designated.
The IRS comes and knock and there's.
Yeah, the IRS says no, I mean, they don't have cameras in your house, so, and. So.
His PC answer.
That word,
Yeah.
started with an A, just move the bed out when they.
Because I have a bonus room, but I have a desk in my printer, but I don't have a dedicated room, so I can't write it off.
Now, if
Yeah.
you do write it off, aren't you supposed to, the IRS wants to recapture that when you sell it, correct?
On your house?
Mhm.
Uh-uh.
Oh, I thought they did. I thought that's
No.
what I had to ask.
No, so and it's really,
Yeah,
It's just such a
it-
small amount, it's not. that
it
big.
is, it's not a, life-changing event there. They give you $5 a square foot if you do the simplified method. 99.9% of people do that, up to 500 square foot. So it's a $2,500 deduction,
How much
So-
of marketing can we write off?
as much as you spend. Yep.
I
And
spent a lot of money.
Well, and too, friend, I mean, that kind of begs the question of like, okay, is this marketing or is it advertising or charitable contributions? So a lot of times, so charitable contributions are an add back. So what that means is like if your bottom line is 100 grand, okay, that was after your $10,000 of charitable contributions you gave somebody. Okay, we have got to add that back. So now it's 110,000. And it goes to your individual return on Schedule A, which is where you itemize. Okay, if you cannot itemize because you're under the standard deduction, which is ultra high right now, then you have just lost that $10,000.
You're not spending enough money.
So, and let's talk about those charitable contributions are. That is buying a raffle ticket for the chamber, correct?
So in my opinion, we're on the more aggressive side is we're going to recategorize that as advertising
Mhm.
because you're getting your name out there.
Right.
That is a form of advertising in my opinion. So, and that's 100% deductible. So now depending on who you talk to, there's a lot of CPAs out there that are sort of rigid and
Hire your CPA.
black and white type thing. But I think we could easily call that advertising. So now if you're
Sponsorship, like.
Absolutely.
100%, no, ma'am, because the charitable is going to be an ad back. So we got to keep that in mind. So that would be in that $10,000 example, that would be 10K you just lost, and you're going to be paying taxes on it. So now if we're giving 10,000 to First Baptist Church, then that's probably a charitable contribution. I would say that'd be a hard one to say.
Can you talk about, I know I went for years and didn't know anything about a Roth IRA, didn't know that was something that was a possibility. I'm mad that I lost all that money for those amount of years, that I didn't know that was something that I needed to do.
Yeah, so
Certain types of savings like that.
yeah, so you've got a traditional IRA and you got a Roth IRA. So the cool thing about traditional IRA is it is tax deferred, but it is a deduction for your company or for you individually. Okay. And they've got certain limits. They go up every year. I think it might be 6,000 this year, 6,500, something like that. They kind of go up every year, and then you've got a Roth IRA, which is cool because it's taxed already. But when you draw it out after you're of age, then it's tax free for your contribution portion of it. Now, whatever that Roth gains over the years, once you get to that part of the deduction of it, then that becomes taxable. So like if you put 50,000 in a Roth today and you draw it out down the road when you're of age and say there's $70,000. So now you have $20,000 of gain. At some point, when you make those distributions on the gain portion, then you're gonna be taxed on those. But that'll all be laid out on your, you'll get a 1099-R.
I have a 401k from a previous company years ago that's not growing any money. I
Roll
need
that
to
thing
move
over, girl.
into it.
Roll that thing over.
Oh, I need your number and I'll send you all that.
There you
Yeah,
go.
those are my CPA, I think.
So those are things I didn't know, like I said,
It's
so
been sitting there.
well, I had a bookkeeper, I should say, for years and years, and she was sweet as pie, but she didn't help me understand what I was doing and not doing, and so then we actually got a CPA, it was like, oh, I could have, reduced my tax liability if I'd put money away for this. Also, started growing some type of retirement, for lack of a better word, for myself, assuming when I take it out, my tax liability is gonna be a lot different when I'm 65 than when I'm 40.
Yeah, absolutely,
So
100%.
I'd rather pay it on that tax bracket than the one I'm in right now.
Yeah, yeah, absolutely. That there's going to be a, long-term kind of vision there. But yeah, your CPA and then your financial advisor, there'll be two good people to have in your corner, going at it. So.
Is that the one, which is the one that's like you can put up to $3,000 in and it takes away that you're not taxed on that $3,000 worth of your income? What am I thinking? And there's some type of IRA that's like that, like essentially it takes away from your income, but you have to put it permanent.
I'm not sure on that one. But I know, a lot of times, like if you are, say you're a corporation owner and you're the only employee, the perfect thing to do is a SEP. A SEP is absolutely wonderful. Any financial advisor should be a big advocate of that. And the reason why, if you're the only employee, it's the best thing to do is because if you're not, if you got another employee, then you've got to match whatever you put in to that employee. So a lot of people don't like doing that. But a SEP is great because you can put in up to 25% of whatever you pay yourself in a W-2, up to $53,000 contribution.
That's exactly what I'm thinking of, because we have more employees, if they can put up, and we'll match it up to $3,000. That's what I was thinking of. I
Okay.
can do that for myself.
Yeah.
Because I am an employee of my company, so I can set aside $3,000 and then my company will match it, and it's again just more future benefits, and I'm not taxed on that $3,000.
Absolutely. SEP is a great plan. 100% good.
Does your company do payroll?
We do. I've got a couple handfuls, but I try to stay out of that.
Because I have payrolls, if I switch my CPA, I don't think I keep my payroll, so I'm trying to keep it all together.
Hey, I'll tell you what, though, I will say this, okay, is ADP and paychecks and people like that, they are the person to go to for payroll.
Amen.
And this is why, okay? Well, I'll tell you the only dilemma first. The only dilemma is if you have an issue, you might be talking to Sally this week, you might be talking to Joe this week. So there's a lot of turnover at those places. That's the only issue. But it hadn't really been a big issue, I don't think. But they're good because what they do is if you're a monthly depositor of payroll tax, okay? So that means I've got all my June payroll. Well, my taxes that I took out are due July 15th, okay? So what they do is they draft it out way before July 15th. They hold your money, okay, which is not a big deal, but they hold your money and they're doing this on billions of dollars. So that is really how they make their money. They are a payroll company, but they make their money not through payroll. They make it through holding your money. So they can charge an artificially low rate for payroll because that's not really how they make their money. And it would be, there's no way I could do it for as cheap as that. Does that make sense?
We use ADP for years.
Yeah.
Now our bank does it.
Yeah.
I still know that she just files everything, so here's your receipt.
Who said QuickBooks?
Somebody said QuickBooks, who said QuickBooks? I think that's what she uses. Because I use QuickBooks.
We would love to do it. We would love to do it, but I just couldn't beat, there's no way I could beat the price.
I don't like change. That's what I like.
Any other questions for Matt?
Anybody online? I know we got a lot of people in here. If you want to unmute yourself and ask a question.
Hey, I'm just so glad we could do this roundtable type conversation because taxes are pretty boring. Taxes are very boring. So it's hard to talk about something like that because,
Well,
Yeah.
I like it because what worked for me doesn't necessarily work for her, doesn't work for, like,
It
there's
is-
so many different options, and that's why you really need to talk to somebody who knows what they're doing to say, okay, like I said, I had a bookkeeper, but for years didn't look out for my best interest, said at this point, you should have done this. You know, it wasn't my husband started a business, it was like, wait, what do you mean we need an LLC and we need to do this?
100.
And you do that as an agent?
100%. I mean, so there's a ton of bookkeepers out there. You know, there is a difference between accounting, an accountant, and a tax accountant. Major difference, major difference. And there's a difference between just you know, someone that's a CPA and a non-CPA. We're just going to go in a little bit more depth and, you know, try to explain in a way to where it makes sense, because some of this stuff is kind of high level and it's tough, you know, so.
And one of our future trainings, we're also gonna bring in somebody who is like from Edward Jones, who can help you understand, like, that's gonna be a benefit for me, is my Edward Jones guy talks to my accountant and they talk to each other and they figure out, what are we gonna do with this going into next year? So like you said, the whole planning aspect of it is so important. So we'll have them come, because there's also a lot of things that you guys can invest in. That's something. There's also a lot of things we can invest in that will benefit us on the tax side as well.
Yeah, absolutely. And also too, to follow up on that is, you know, sometimes when you talk about investments and that, sometimes the best answer is not the tax answer. And I completely understand that and I respect that. So you just got to look at it from all angles there.
Not asking you to go to prison for me. I'm just asking for you to be open-minded.
Yeah, that's right. That's right. Yeah, absolutely.
Creative, I like the creative.
I mean, honestly,
we
you need
creative.
someone that can look at what you're spending and say, okay, well, what do you need out of this? Because it's like, I feel like a lot of these accountants and CPAs are looking at it as, you want to show that you're making income, but I'm not looking to buy anything. I have my house, I have my cars. I just want to not owe the IRS.
Yeah.
You know, but that might change. Next year, I might come to you and say, Timothy needs to make money. We want to buy a new house and I want to be able to have that conversation. So I feel like, I know Lana's accountant is someone out of New Jersey that she calls and says, I have expenses. And he's like, you can't use that.
Yeah.
And
That's a very
problem.
common, that's a common theme there. That is a common theme for sure.
Yeah.
A lot of times, and not talking badly here, but a lot of times when you have that conversation like that, you hear CPAs and other tax people say, you know, what you can't do. All right, well, what can I do? You know,
Yes.
that like they always say, oh, you can't do that, can't do that, can't do that. Well, what the heck can I do? You know, I mean, that's what I've noticed. So
It's just so polar because like we have the same income because we split everything, but I got a refund this year and she had to pay money.
yeah,
So,
yeah, absolutely. Absolutely. No, they're
Hey, Lana, they
You
might
just
be
put
able
that
to go
in?
back, they might be able to go back and adjust your tax.
exactly. And they should be able to because we have a
Yeah.
lot of advertising. I guarantee you did not write off enough advertising,
Yeah.
but you're getting a new car this year.
You're gonna get a new car this year and we'll worry about it for next year.
That's right. That's right. No, if anything, I would say the advisory portion, that is the value there. Cause I mean, if, you know, we've had examples where we save clients sometimes over $100,000 in taxes. There is a value to that. That is worth something.
It's worth
You know?
$100,000.
Well, it's not quite worth that much, but it's a fraction of it though.
So we have someone asking, what is the best way to contact you? Do you have a website or email, phone number?
Yes, so email is Matt, MATT, at mbcpa.cpa. That is .cpa. Phone number is 919-948-8508. Text, call, email, we're available always.
Thank you, Alice, for typing that out.
Hey, look at that. She got it right. Cool.
You want to spell out your whole last name?
No, we'll leave that alone.
And if you're online and you were not in person, you missed swag.
We got, you know,
Too bad, so sad.
put your pineapple Malibu in it and we hit the beach or something. Come on.
Frozen drinks?
Yeah, that's right.
Yes. All right. Well, thank you so much, everybody on
Awesome.
Zoom.
Thank
Have a great
Appreciate
day.
y'all.
Thank you so much.